Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding Equity Swaps, an essential guide for today's investors. Market risks. Market risks are a fundamental concern for anyone involved in equity swaps. Just like riding a roller coaster, the markets go up and down, sometimes unpredictably. When market prices swing, they can greatly affect the cash flows exchanged in an equity swap. Imagine you've entered into a swap agreement tied to a particular stock index. If that index dips, the returns you expected might shrink or vanish. Even small fluctuations in the underlying asset can lead to significant impacts on the swap's payoff. This is why keeping a close eye on market trends and economic indicators is essential. Volatility exposure. Market volatility is a given. Any sudden swings can dramatically change the value of your swap position. Price movements. The underlying asset's price directly influences the returns in an equity swap. A poor performing stock can lead to losses. Interest rate changes. Often, one party pays interest on the swap. If rates rise unexpectedly, it can increase costs or lower returns. While not all market risks can be avoided, being prepared and proactive can help manage these challenges. It's like having an emergency plan for rainy days when you least expect them. Counterparty risks. Counterparty risk is about trust, the trust that the other party will meet their financial obligations. In equity swaps, each party depends on the other to follow through on the agreement. But what happens if the other party fails? If your counterparty defaults, you might not receive the value you're owed. This can lead to financial losses and legal complications. To reduce this risk, you need to consider several protective measures. Credit checks. Before entering a swap, ensure your counterparty has a solid credit rating. This reduces the chance of default. Collateral verification. Use collateral agreements. Requiring collateral can provide a safety net if things go awry. Regular audits. Regularly audit your counterparty's financial health. This helps catch issues early before they impact the swap. Diversification. Don't put all your eggs in one basket. Diversifying counterparties can lower the impact of one party's failure. Pay attention to counterparty risk management in swaps. It helps protect your investments and maintains trust within financial interactions. Regulatory considerations. Navigating the regulatory world of equity swaps can feel like walking through a maze. It's crucial to understand the rules and regulations that govern these financial tools. They directly impact how swaps are traded and reported. Let's dive into some key areas of regulatory focus. Dodd-Frank Act implications. The Dodd-Frank Act brought sweeping changes to Wall Street. Equity swaps weren't spared from its reach. This legislation aimed to increase transparency and reduce risk in the financial system. How did it change equity swaps? Let's break it down. Mandatory reporting. Under Dodd-Frank, equity swaps must be reported to swap data repositories. This ensures regulators can monitor the market more closely. It's like having a watchdog that never sleeps. Central clearing. Many equity swaps now require central clearing. This means a third party steps in to guarantee the swap. Think of it as an insurance policy for both sides, reducing the risk of default. Trading platforms. Equity swaps often need to be traded on regulated platforms, known as swap execution facilities, SEFs. This boosts market transparency and competitiveness. More transparency can lead to fairer pricing. These changes were designed to prevent the next financial meltdown. But they also add layers of compliance for swap participants. Are these layers a burden? Some might think so, but they're intended to protect the market from undue risk. Global regulatory landscape. Equity swaps aren't just a U.S. story. They're traded across the globe, and each region has its own set of rules. Understanding the global picture can help investors navigate more smoothly. Europe. The European Market Infrastructure Regulation, EMIR, shares goals with Dodd-Frank. It mandates reporting and clearing for equity swaps. European regulators focus on reducing systemic risk and increasing transparency. Asia. In Asia, countries like Singapore and Japan have their regulations. These often mirror US and European standards but with regional tweaks. For instance, Japan has the Financial Instruments and Exchange Act, FIEA. It covers similar ground as Dodd-Frank and EMIR. Emerging markets. In some emerging markets, regulations may be less stringent or still evolving. This can offer opportunities but also carries additional risks. Investors need to weigh these when trading equity swaps globally. The world of equity swaps is not one size fits all. Depending on where you trade, the rules can look quite different. Understanding these variations is key to making informed decisions. Are you up to the challenge of keeping track? It might seem daunting, but staying informed is the best way to protect your interests. Equity swaps in practice. In the real world, equity swaps serve as powerful tools for investors and institutions. They allow participants to control risk and maximize returns without needing to own the underlying assets. Let's examine how these transactions unfold in practice and what the future holds. Case studies. Present case studies of significant equity swap transactions and their outcomes. Equity swaps have been at the heart of some notable financial maneuvers. Here are a couple of real-world examples that highlight their impact. Hedge fund strategy. A major hedge fund used equity swaps to gain exposure to a basket of tech stocks. They wanted the benefits of holding the stocks without the upfront cost. By structuring the swap, they paid a floating rate and received returns based on the tech stock's performance. This strategy paid off as the tech sector surged, leading to substantial profits without the hassle of stock ownership. Corporate risk management. A multinational corporation engaged in an equity swap to manage its exposure to currency fluctuations affecting its foreign investments. The swap allowed the firm to lock in returns tied to a stable equity index, hedging against currency risk. This move stabilized their investment returns despite volatile foreign exchange rates, demonstrating the power of swaps in risk management. These cases illustrate how equity swaps can be harnessed for both aggressive growth strategies and prudent risk management. Market trends and innovations. Discuss recent trends in equity swaps and potential future developments. Equity swaps continue to evolve, influenced by market dynamics and technological advances. Here are some trends shaping their future. Increased customization. There's a growing demand for bespoke equity swaps tailored to specific needs. Investors now seek swaps with customized terms, including unique underlying assets and flexible payment structures. Integration of ESG factors. Environmental, social, and governance (ESG) considerations are becoming more prominent. Investors are looking for swaps tied to ESG indices, aligning financial returns with ethical values. Technological advancements. The digital wave is revolutionizing equity swap trading. Blockchain technology, for instance, promises to enhance transparency, reduce transaction costs, and streamline settlement processes. Regulatory shifts. As global regulatory landscapes shift, new rules may further shape equity swap practices. This includes potential changes in reporting and clearing requirements, aimed at reducing systemic risks. The landscape of equity swaps is rich with possibilities. Investors and institutions must stay ahead of trends to capitalize on these opportunities. Are you prepared to leverage these tools in your strategy? Keeping an eye on developments ensures you're not left behind as the market progresses. Conclusion. Equity swaps are tools that can greatly enhance investment strategies. They let you gain market exposure without holding actual stocks. This can mean lower taxes and less risk. But they're not without challenges. Market and counterparty risks require careful managing. The right strategy can make these swaps a powerful ally. Curious about how equity swaps can work for you? Start by diving into your financial goals and risk tolerance. Then, explore if these swaps align with your strategy. Thank you for being part of this exploration into equity swaps. Have thoughts or questions? Feel free to share, they could spark future topics. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.